So the article goes on to say that OSFI faces criticism following a Globe and Mail article about its slow response to mortgage market risk, specifically regarding lenders issuing high-risk blanket mortgages. That just sounds scary right there. High-risk blanket mortgages on pre-construction properties.
Yeah, it's blanket appraisals that are being used to value the mortgages.
Yeah,
I think.
Yeah. So critics worry that OSFI's lengthy testing approach could let serious financial risks develop unchecked. And this delay adds to ongoing concerns about mortgage oversight as buyers report pressure to close on some of these properties that have been devalued in the tens, if not in the hundreds of thousands in some cases.
Oh yeah, I'd say like the average, like if your 2021 vintage closings on Toronto pre-cons, I mean, we've done full episodes on this, many analyzing it, and I think I'm probably the most well-researched on sort of the risk. I imagine the banks probably have their own research on this as well that they don't put out publicly, but I think publicly probably putting out the most research on this. And let's just kind of go through it just quickly to summarize. So lenders are issuing mortgages with loan-to-value ratios that are probably over 100% on pre-construction properties that have declined in value. These mortgages started at 80% loan-to-purchase price. Okay, so purchase price LTPP, not LTV. LTV is loan-to-value. But they become riskier and the LTV goes up as the value, the V, drops. The P, purchase price or PP, doesn't change, right? This creates concerns about the insurability of these as well. You know, a lot of people have been asking, are these, financial experts, media, and affected borrowers have all raised alarms about whether or not these are going to be insured and sold in mortgage bonds. And OSFI's sort of facing criticism in regards to their slow response and not really commenting on this. Like the journalists that I've worked with on this story who've asked me about it, they've said, yeah, OSFI just hasn't commented. So I think that this issue will only gain attention with broader discussions of replacing the stress test, the bank oversight that we're going to talk about, the two articles that we're going to talk about today. If they're ignoring other risks like this one while trying to kind of play whack-a-mole with policy on other risks in the Canadian housing market.
Whack-a-mole is fun at the carnival. It is not fun in the general Canadian economy here. Dan, the article that you're referencing is that one from the Adams Family. Toronto buyers left in lurch as pre-constructed condos now worth less than the original value. So let's look at some of the key points from this article. Okay, they provide a case study. Okay? A guy purchased a $2.2 million pre-construction condo in Leaside. Wow. But it was later appraised at only $1.6 million from 2.2 to 1.6, creating...
Yeah, so let's do the math on that. Had they lent on that, had somebody lent at 80% of loan to purchase price, okay? So if the banks lent at 80% of 2.2, they would have lent 1.76 million, okay? Now, if it's only appraised at 1.6 million, you can see the problem here. Now you're at like 110% loan to value.
Yeah, not just that, but there's also a value gap of almost $600,000 there, right? So, pre-construction condos across Toronto are being appraised anywhere between 10 and in some cases up to 30% below their original selling prices. This is a big problem. The scale of this problem is huge. And, the expected completion of just under 31,000 condo units between Toronto and Hamilton in 2025, and that surpasses the 2024 record of just under 30,000. Now, lenders are providing mortgages based on current appraised values, not that original purchase price. So what are your options if you are one of these people in this unfortunate situation? You're one of these buyers. Well, you can forfeit your deposits. You can seek additional financing to help bridge that gap, that 10 to 30% gap. Or in some cases, you can accept developer-arranged financing solutions, like the one that we've mentioned with RBC's blanket appraisal. Now, what is this going to do to the overall market? Because the condo sector here in the GTHA is massive. We just went through a huge condo boom over the past decade plus. So investors are leaving, not even just leaving, but fleeing the pre-construction market. Where there was once lineups to buy these things, there are now lineups out the door. This also puts downward pressure on prices overall, and rental units are operating at monthly losses. And you can see this in the rental market space here in the GTHA. There is a crazy amount of stuff listed for rent, but also for sale. And it's basically just, I'll take whatever I can get, is the attitude of a lot of these investors, unfortunately. Now, what caused all this? You may be wondering. Well, a few things. Aggressive interest rate hikes. I'm sure you remember those. Construction delays through COVID and supply chain issues. We've seen an overall market slowdown, and then a decrease in demand, and of course, a few other contributing factors. But last but not least, the stress test.